Good afternoon and welcome to the Jon Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. John is under the weather. I'm doing my best to stay above it, but that bug is getting everyone around here. It is not fun, but hopefully he will be back soon. Tonight I will guide you through the markets, give you a little update on where things are, why even though earnings were decent today, markets swooned, and at least give you a little bit of color on where I think things are going over the next weeks, months, and quarters. But to start things out, why don't we dive right into markets? We had a Dow today that was down 42 points, or 0.09%. Not a big deal. A win for the Dow today. 49,149. The S&P was lower by 37 points. That's down 0.5%, or 0.53%. 269.26. And the NASDAQ, it was down 1%, 238 points. Gold continued to climb that wall of worry, and we'll touch on that a little bit later. Up 0.75% to 46.33. Oil was lower by about 10 cents, $61. It was up 1.5% earlier in the day, and then gave back some of those gains based on some headlines that President Trump put out about essentially that the killings have stopped or severely been reduced in Iran. Oil prices have been rallying over the last several sessions out of concern that the U.S. is going to get involved in Iran, given a lot of the rioting and loss of life. I think 25,000 people, or 2,500 people have died so far in one way, shape, or form. But those are part of what the market gets angsty about. The constant barrage of data, right? You've heard me say a number of times, the market doesn't like what it doesn't know. Oftentimes, known bad news is better than all this sideways, up and down, and left and right, and comments here and tweets there, and whatever Truth Social posts are called. The barrage of data, it doesn't stop. I feel like every single day there's 7 or 8 different comments that are made, be it Fed-focused or Greenland-focused or Venezuela or you name it, and the market is going to de-risk. And the more and more we get concerns of the real big thing of interest rates going down, which I think has helped with a lot of the buoyancy that the market has held on to into 2026, with the thought that we probably get potentially 2 to 3 rate cuts. Some say more, some say less, but the average expectation is another 50 to 75 basis points of rate cuts in 2026. That was taken off the table a little bit, or at least pushed sideways on the table today, because we got November Producer Price Index. Recall yesterday we had CPI, but today we had November Producer Price Index. And while the headline month-over-month number of a positive 0.2, which was in line with consensus, and even core was flat month-over-month, the year-over-year numbers are still much higher than anyone wanted, right around 3% on headline Producer Price Index. And with CPI yesterday that was broadly in line, things aren't coming down as much as those who are in the cut rates camp would like. And if inflation becomes a problem again and you stimulate demand, which is already pretty strong, because we had November retail sales that showed an increase of 0.6 versus a consensus of 0.4, that shows strong consumer, prices that are stubborn to come down, and the concern of more stimulus into this buyer. And that had many thinking that now rates probably don't get cut in January, and it could be as late as whenever the heck President Trump puts a new person in that seat. The market needs that stimuli, especially given where valuations are, to help it stay calm around the commentary of the minute, the day, the hour. But if you're not getting that, the market's going to start to de-risk, and that's a bit of what we saw today. And it's been bifurcated, I've found. One day it will be the value stocks that do poorly as growth does well. And when I say value, simple math is to look at the Dow versus the NASDAQ. If the Dow is up and the NASDAQ's down, yes, there's some growthy names in the Dow, but they've got more industrials and more of a value tilt to it. That's what I'm seeing, if value up or growth up. Today, growth was a big lagger. In fact, I believe all of the Mag 7 stocks were in the red today, or the not NVIDIAs, the Microsofts, Amazons, etc. Those were in the red today. Another data point that we had today, earnings season is starting again. As much as I don't like it, comes every quarter. And we had JP Morgan yesterday, was okay-ish numbers. We had Bank of America today. We had Wells Fargo today. We had Citigroup today. And any other time, you'd have seen the results and thought they were pretty good. You would have, they by and large either beat or met numbers. And all of them were down 3 to 5% today. Part of what I wanted to touch on is many times earnings are important, but it's also where you're at in the cycle, right? Financial stocks have done quite well. I believe they were up 20% or more last year, and the setup isn't very favorable, right? Same thing. These entities need more good news. They need a consumer who is going to continue to spend, and they need stimuli to the point of lower interest rates that potentially help more borrowing take place. Banks are a little tough with interest rates because they have a thing that they focus on called net interest margin, which means how much money can you make when you're lending. And really, it's just a spread function of I lend at a rate versus I borrow at a rate. So if I can borrow from you in your savings account, earning in some of these banks jack and squat, but let's pretend that it's even in a high yield savings account, and they're paying you 3 to 3.5%, but they can then go lend that out at 7%. They're borrowing short and lending long. So if they're borrowing, lending to someone for 5 to 7 years at 7%, but they can borrow over and over from folks on the shorter end of the curve at 3.5%, that's their net interest margin. Well, a flat treasury curve doesn't help them as much, but the thought that the shorter end of the curve can continue to go lower helps them because they borrow at that short end a lot of the time. And as you've seen at the 20-year and 30-year, longer rates are much higher than current rates. And while that's not a direct linkage to where banks lend, it does give some information as to that net interest margins are favorable, and all of them showed pretty good net interest margin results. However, the market sold off many of them because it's a bit of the sell the news. They're kind of off to the next thing. Banks have done well. They've taken advantage of some of the recent stimulus, but market constituencies are often fickle. So we'll see what happens with them. I still like the financials overall, but a bit of a surprising reaction today to what were overall decent numbers. Another thing that's been causing near-term angst has been this Supreme Court ruling on the legality of President Trump's tariffs. I believe it's the third time today, including, that we thought we were going to get the numbers, the market was weak, and then they said they weren't going to vote today, and the markets lifted a bit. So the market certainly tilted more bearishly into, I believe they said there's a 30% chance that he gets to keep them. So the market's sort of already betting that the Supreme Court's going to pull them away. And there'll be a lot of back and forth. And I think Hassett said something that, we have other ways to get the tariffs into place. But the market is expecting that a ruling means they're going to rule against. The fact that they keep kicking it down, who knows? Maybe they're thinking of more parts, or they just don't feel like dealing with the fire. The Supreme Court did not make that ruling, but that will be something that I expect we get in the next couple of weeks. So that is going to present itself as a bit of an overhang. Another overhang to financials going back on is the cap for a 10% cap on credit card rates. And the CEO of Bank of America, Moynihan, someone asked him today, what do you think the result of a cap on rates would look like to credit cards and lending? And he said that he expected that lending would be severely reduced and that many people who have credit cards would get them yanked. That if they had to cap interest rates at 10%, he said you'd probably have to be a mid-700 score to get a 10% rate. Otherwise, they'd be yanking a ton of credit away from people. So while you think you have a $10,000 credit line on your credit card, you could see that shrink to $2,000, right? They would pull back credit because those rates are there for a reason, in that they subsidize borrowing in general, that some people pay higher interest because of the fact that these banks have 3 to 5% charge-offs, as in people don't pay back the credit. And the banks need to charge these high interest rates. Do they need to charge that high? Again, probably somewhere in the middle is the right answer. But they do have these rates at such a high level because it makes it where you don't want to not pay your credit card. It is very much a penalty to miss out on those payments, so it disincentivizes people to either default or keep those balances for a very, very long time. I've often thrown out what happened, I believe was in the 80s, where you could deduct credit card interest, right, to help either stimulate parts of the economy, and it would probably go to lower income borrowers, where it would help them more because most folks don't pay credit card interest, and if you do, you shouldn't be. Right, it's there for short-term credit. Paying what are loan shark rates of 15 to 20+% on a credit card is something that you should certainly talk to a financial advisor about trying to figure out a way out of, because that's not a recipe for success. So those are things that are certainly weighing on the market. I'd say the last thing, at least in this segment, is energy, right? Everyone keeps thinking that the oil prices are going to go lower. Ever since Venezuela took place, oil prices have gone up. Today with crude at $6 a barrel, that's a big move higher off of the mid 50s just a week and a half ago. Energy sector was up 2+% today, right? So like we've talked about before, having a diversified portfolio, even though energy is about a 3.5% weight in the S&P 500, maybe that's a time to tilt a little more aggressively towards energy, because it seems like the risk is to the upside in that space, even though everyone thinks that prices are going lower. And the same thing on the flip side. I'm going to start saying this louder and louder. Everyone thinks that gold and silver are going higher. I think that there's probably a pretty decent pullback coming in that space. Can't guarantee anything, but my chart sense feels like we might be near to something soon. Why don't we check in now with Kristen Snow in the Right Now Traffic Center. How you doing? Good afternoon, and welcome to the Jon Sanchez Show yet again. This is Jason Gaunt. Today the Dow was lower by 42 whole points, or 0.09% to 49,149. S&P, it was lower by 37 points, 0.53% to 69.26. The NASDAQ was down 1%, 238 points, 23,471. Gold here in the new session is down $14 to 46.21. Oil right at $61. That's 1.6% lower on the new session as well. We did get the beige book. This is the Fed report where they go through all of the districts and all of them speak in Fed language and walk through how each of their districts are doing. Overall economic activity increased at a slight to modest pace in 8 of the districts, while 3 districts saw no change and 1 reported a modest decline. Consumer spending increased during the holiday season, with higher income consumers fueling the growth, while remaining groups became more price sensitive. Auto sales were little changed, while manufacturing was mixed. Residential real estate activity softened, and employment in most districts was little changed. So we'll call it a draw. Not major takeaways, no real concerns around spiraling higher prices, but the higher end consumer continues to support a lot of the economy. I think Delta said yesterday, I mentioned on the show last night, that they saw 9% increases in the first and business class as far as revenue was concerned, and then met by a 9% decrease in the rest of the plane. So the haves and have less continues to be a battle, and the higher end consumer is helping spend a lot as far as the economies are concerned. Looking through some of the headlines today, many of them are Trump-related. Said in an interview that U.S. will take very strong action if Iran officials begin or continue the sort of atrocities towards protesters. I mentioned 2,500 have been feared dead so far as these riots are concerned. Even though later in the day he did make comments that he believes that they have reduced or even made comments about not taking that as their next step, the Iranian officials. So the oil prices actually did trade lower post those comments. More on Greenland and Denmark. It looks like there were some meetings today. The President Trump said Greenland should be in the hands of the U.S. and anything less is unacceptable. I believe the head of Denmark came out with some contrary comments, but conversations are still in progress over the next couple of weeks and months. China, their trade surplus reached $2 trillion, according to Bloomberg. President Trump also said, this is pretty interesting, Jamie Dimon, the CEO of JP Morgan, made some comments saying that really two things. One, that it was wrong. President Trump said that he was wrong to suggest that President Trump was undermining the independence of the Fed. And he also made some comments about Jamie Dimon and the credit card rates, right? Clearly the banks are probably incentivized to keep those rates higher, but the independence of the Fed is something that is going to be thrown around for some time. And that's part of the anxiety that we've gotten earlier in the week. I think it's part of for the reason why we've seen the continued strength in some of these metals, copper, and a bit of a flight to the risk off from currencies, and that's where it tends to manifest itself. Certainly inside of the copper and gold and silver, etc. Also in China, firms saw a couple one-liners today where firms are going to be, local Chinese firms are going to basically move away from using U.S. and Israeli security software. They're going to be tightening their margin requirements in China as well. But the comments around U.S. security software is not a big surprise, but that whole space, the Fortinets, the CrowdStrikes, the Palo Alto networks, have been in quite a drawdown. People really love them for all the reasons of concerns around AI, hacking, and this, that, and the other. But that's a space too that I think is going to find a level at some point for an investment opportunity. In fact, President Trump made a comment about using some of those companies towards the government and helping with some of their security and software security as well. So I think that's not a recommendation, but one to keep an eye out, because I think a lot of these things have been beaten up quite a bit because they had a lot of momentum earlier last year. Couple other comments here. Feels like most of them start with President Trump, but he said that the first sale of Venezuelan oil netted about $500 million. That's according to Semaphore. Remember, they were of the ilk that any of the profits or any of the income from these oil sales are going to be kept in U.S. banks until Venezuela is in a position to take over those assets and do well with them. And then finally, they did some good news here. He signed legislation that requires national school lunch programs to include whole milk and 2% milk. So what to do with that, I'm not quite sure. I just thought it was an interesting line. But why don't we check in with Jack Saban, who has news, traffic, and weather. How are you, Jack? Welcome back to the Jon Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. Today, the Dow closed lower by 42 points. The S&P was lower by 37 points. And the NASDAQ was down 238 points. Gold currently is down $14 to $46.21, and oil at $61. That's down $1 here in the new session. What I wanted to do is go through a good article I had both on sort of expectations as well as even just a week in review from BlackRock. They put out a really good note that we can always send over if anyone is interested. But I thought I'd dig in first just to give a little highlight of how they saw the end of the year and then what sort of expectations are over the next quarter or so. The last 3 quarters of 2025 were characterized by a relatively boring, low volatility rally. We view the current market equilibrium as somewhat fragile. Flows and pricing insights point to signs of market complacency, and we enter 2026 with limited directional equity exposures, short positions in long-dated government bonds, and short the U.S. dollar. So I'll just stop there real quick, just stating that overall equities seem like they're muted. A short position in long-dated government bonds means that they're of the opinion that interest rates on the long end are going higher. And then the dollar, which was down about 10% last year, they can take a negative bet on the dollar or just be long other currencies, own the euro, own the yen, things like that. Divergences of corporate earnings trajectories, central bank balance sheet operations, and national fiscal policies have increased cross-country dispersion. As we start 2026, this creates a rich opportunity set for high-breadth macro investing approaches. So it just says there's a lot of things going on in many of these different countries that not everything's moving together, right? When you have dispersion, that's the opposite of correlation. So dispersion's typically a stock picker or a macro picker's market, where correlation is you can just own index ETFs, and everyone makes money all at the same time. So dispersion, good for stock pickers. Correlation, good for index holding. So Taylor Swift's release of Life of a Showgirl might rank as one of the more interesting events of the last 150 days of market trading. I couldn't tell you a single song off that. After a tumultuous first 63 days in 2025 that included DeepSeek, German fiscal emergence, and Liberation Day, markets then went on to spend 3 quarters climbing higher in a relatively boring, low volatility rally. Those are my favorite. Global risk assets currently embrace a Goldilocks mindset towards the one big beautiful bill, tax cuts, European rearmament, U.S. dollar weakness, Federal Reserve dovishness, as in rates go down, doves go down, hawks go up, and AI capex. But below the surface, macro risk continues to be a meaningful driver of regional stock and bond returns that offers a rich opportunity set for those able to capitalize on economic divergences and price dislocations. As we look forward to the upcoming year, we believe that unbalanced positioning and high prices create a fragile market equilibrium. The broad risk rally of the last 2 years has crowded in many investors, and our flow and pricing insights show signs of complacency. The recent AI-enthralled market narratives rhyme with the U.S. exceptionalism euphoria that characterized markets in late 2024. Correspondingly, we hold minimal directional positions and maintain a relatively contrarian portfolio focused on more attractive risk-return opportunities available in relative value or certain country positions. In the month of 2025, however, the Federal Reserve managed to both end its second quantitative tightening program, QT2, and quickly initiate a new set of asset purchases. QT2 accomplished little in terms of financial tightening in overall conditions, and the U.S. and Fed's ownership of outstanding government duration actually increased through 2025. This counterintuitive loosening of U.S. financial conditions, juxtaposed against the balance sheet tightening delivered by European central banks, has created some of the dollar weakness we talked about, and we think that the pandemic-related asset purchases where the Fed and Bank of Japan have had de facto delayed a balance sheet normalization. So you've seen this sort of pull and push of all the things that were done during COVID, the follow-through unwind of many of those positions, but the Fed still is in a spot, both here and even European and Asian Federal Reserve boards and quantitative owners of those assets have put themselves in a spot now that we're at the next steps part. And I think now we start to look more at the U.S. and think of where things are set for the next quarter, where U.S. corporate earnings strength is broadening. Earnings resilience and mega forces like AI is continuing to keep them at least somewhat overweight in U.S. stocks. The S&P kicked off the new year on a positive note. Remember, we touched all-time highs. And U.S. Treasury yields have been pretty steady so far. In fact, bonds were down a touch today, even though not down a lot, merely because we've got a situation that, we're not quite sure if we're going to get those Fed cuts as soon as everyone thought. Solid U.S. economic growth and Federal Reserve rate cuts have boosted corporate earnings and profit margins, lifting U.S. stocks and underpinning their overweight in U.S. equities. We think this will keep playing out in the Q4 earnings results that are starting now. We see 3 themes: a further narrowing of the earnings gap between the Magnificent Seven stocks, the NVIDIAs and Microsofts, etc., and other sectors, mega forces supporting cyclical sectors, as we've seen industrials come on, financials, other areas that are starting to gain instead of just the big 7, and AI-led productivity gains potentially offsetting typical earnings weakness. The U.S. corporate earnings season is the key after the S&P 500 posted a 3rd straight year of double-digit returns in 2025, while international markets from Spain to South Korea also delivered strong results. Quick stop there. International markets are up already this year 4.5%. Emerging markets are up north of 5%. The interesting part is small caps are up over 6%. I think the S&P after today is up 1%, right? So again, you've got this tend to have a bias towards U.S. large cap. People in the U.S. tend to do this. it makes a ton of sense to be diversifying your portfolio away from large cap U.S. growth to some of these other areas that you can pick up a heck of a potentially risk-adjusted better return just because they're cheaper. And, you've seen small caps, the ETF that tracks the small caps, I guess I can talk about it now, the IWM relative to the S&P 500 is starting to outperform, and it's underperformed for like 5 years. And we just broke higher over the last week or two. So that's something to keep a close eye on. Those trades can go on for years. So, if you don't have small cap exposure inside of your account or portfolio, take a look at it, right? Adding, not saying to go full send and, take on a lot of risk, but these are times to be dipping your toe in the water because this could last for a couple of years as you're diversifying a portfolio. The AI build-out and easing tariff concerns kept economic growth resilient, and we expect that to continue, helping U.S. earnings beat expectations in the third quarter. We think earnings can keep delivering, partly as U.S. stocks driving earnings growth broaden out. The gap between the Mag 7 stocks like NVIDIA, et cetera, and the rest of the S&P 500 is narrowing, and the other 493 could see earnings improve. The first theme we're watching is that. And yet the Magnificent Seven are still delivering strong earnings growth. They've consistently beat expectations in early years. In recent years, we continue to expect they do so. We still broadly prefer tech as earnings growth looks healthy. And again, this is BlackRock comments. And we think it's poised to broaden. But within the U.S. and globally, S&P earnings and profit margins have also proved more resilient to tariffs than many investors expected. Consensus expectation for the Mag 7 have been revised upward to show 20% earnings growth in the fourth quarter. That's the one coming up versus a year ago. And then holding up to 19% potentially in 2026. That's what earnings expectations are, right? So I mentioned starting out the show, it's not necessarily what earnings are. It's what people expected they were going to be. And right now, they're expecting pretty darn good both this quarter and a year from now. So if they're not great, you're setting yourself up for failure, right? And that's something that everyone needs to be thinking about. You typically, if you think that things are going to be better than expected, that's something you bet to. But if there's a lot priced in, things could, typically go one way. And so I think just sort of tempering expectations a little bit going into next year is something that all investors should be doing, not only from reciprocal tariff reasons, but just that we've come off of 3 very good years overall. And then finally, mega forces and lower Fed policy are helping boost cyclical sectors linked to stronger growth. Industrials, materials, much like you've seen cement stocks and industrial stocks, even in industrial materials like silver. While I think that's more of a mechanical and momentum trade, copper has started to pick up. So materials can be a place that you can find some alpha here in this year. This is not a typical business cycle, and some of these forces are trumping the traditional macro in driving returns. But we still think sectors including industrials and materials sit at the intersection of mega forces, AI, energy needs, etc. So those are spots that you should start thinking about as well as far as portfolio positioning is. Things have done well, but where's the puck moving towards? And I think materials, industrials, small caps, it's really what they're trying to highlight in this note are spots that you should certainly keep a close eye on. Again, keeping a close eye on the roads. Why don't we check in with Kristen Snow in the Right Now Traffic Center? Welcome back to the Jon Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. Taking a look at the futures here pre-market, really post-market, pre-tomorrow. We've got the Dow futures. They're down 72 points. So that's 0.15%. S&P futures are lower by 9 points, 0.13% lower. And the NASDAQ futures down 40 points or 0.16%. Oil moving in the right direction, down 2.1% now. And interest rates are at 4.13 on the 10-year. I'm actually sort of surprised that the markets didn't act better today. I think it's very specific to a handful of names, but just given that rates were moving lower, it wasn't necessarily just a risk off by bonds, but interest rates were ticking a touch lower, which ultimately will probably cause more upside pressure in equities if we do get a break of a 10-year, below the 410 level. I'd say anything above 420 would be the opposite, where markets would start to be a little unhappy about that, but we're right in the middle. Taking a look at some of the data that we will get tomorrow. I can't believe it's Thursday already. We'll get weekly initial jobless claims, looking at 210,000. It's a touch higher than the prior week at 208,000. Continuing claims right at 1.91 million. Those ticked a touch higher last week, the continuing claims, right? I think as long as we stay below the 2 million number, that the market won't get too angsty around jobless claims or jobless changes. We'll get Philly Fed that is looking for a consensus of -5. Philly Fed's always a good indicator for inflation and commentary out of that district. And we'll get Empire State Manufacturing that's more of how our business is spending, looking for just a +1 number tomorrow. We'll get weekly national gas inventories as well a bit later in this session. As far as earnings, pre-market tomorrow, we will get earnings from BlackRock. Always a ton of color out of them. Their CEO, they're the biggest ETF provider, so they see a lot of clarity into flows. And, again, I mentioned the article I just read from them. So I like seeing notes from Black. And Goldman Sachs and Morgan Stanley will both have results tomorrow. I think of Bank of America, Wells Fargo, those types of banks, Citigroup, more in the multi-line banking, more the consumer-facing, loan-facing, whereas where you get results from Goldman Sachs, Morgan Stanley, they're going to give you more color on the trading environment, financial advisor space through Morgan Stanley. So different read-through. So I'm really interested to hear results from those guys, which we will get, as I mentioned, tomorrow morning. Taiwan Semi is tonight, TSM. That's going to give a lot of color into semiconductors and just overall production. And then after the close tomorrow, we will get JB Hunt, big, trucker, long haul, less than load, good color from them in terms of what the, overall economy looks like. I know some managers that always, it's a good one to dig into and listen to their report. But thank you very much for listening to me ramble on tonight. And if we can be helpful at all, please don't hesitate to reach out at sanchezgaunt.com or 775-800-1801. I'm Jason. Jon Sanchez Show, News Talk 780, KOH.
John Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.